a lot of the clients that come to us, they typically want the self-serve model, right? They want to primarily be able to do everything themselves.
How do you make sure that the RMs don't just take it for granted, and that there will be a robust, the human in the loop is not just there to tick the box, but to actually really query what the agent is suggesting?
Yeah, no, so that's a very fair question. I think based on what we're seeing, fundamentally, most banks are seeing AI agents as a way to increase the efficiency of a banker, not to replace, advisors or bankers, right? If you think
That was Amanda Ong of Arta Finance and AI native wealth tech. What does that mean? What does that mean if you're a legacy private bank? Are they your friend or your foe? What does it mean if you're a high net worth individual looking for wealth services? To what extent is AI a differentiator in wealth management? How and why? I'm James DiBiasio, and this is my report. Amanda Ong from Arta Finance, welcome to the program.
Thank you so much for having me, Jay.
My pleasure. So you are Singapore's CEO and head of international for Arta Finance, a very interesting wealth tech company with very high pedigree backers. And I've been interested in what you guys are doing because I feel like you've been trying to kind of bring a wealth tech solution to areas that even just a couple of years ago, we would have said were going to remain the purview of traditional private banks for some time. So I'd like to ask, really, first of all, just how is that going? Like, obviously it's your business, but maybe you can give us a sense of where you're gaining traction, the types of clientele that are using you, and how this might be different from, say, you used to work at Stashaway, so you've been in the wealth tech business. You've worked at large financial institutions doing wealth distribution. So just give me a sense of what's different about the clientele here, or if you are fighting for the same types of folks.
Yeah, absolutely. So, as you know, Jane, we run two main lines of business. We have a direct-to-consumer business as well as a B2B partnerships business where we work very closely with a number of banks globally. On the direct-to-consumer side, we primarily serve accredited investors. So on its own, we are quite different from your typical retail platforms, like the ones that you just mentioned. We offer a suite of investment products that is a lot more extensive than what you would see with other digital platforms as well. So we kind of offer the full gamut of private market investments, structured products, and public markets. And for us, we've been live now in Singapore for 1.5 years, in the US for 2.5 years now.
Okay.
And we've seen great traction. I think, we are seeing primarily our investors coming from folks that are working in financial services. So that's actually the top industry represented, followed by technology. So, we're seeing a lot of our members are typically investors that, do fund management themselves or actively traders themselves on a day-to-day basis, but they're actually investing with us. In terms of traction and what we're seeing, we've been growing quite organically through, really referrals. So friends bringing on and recommending us to family members and friends themselves. We see quite a bit of traction around our private market and structured products offerings in particular. And that's really a key differentiator for us. So as you know, on the private market side, we offer kind of access to very exclusive funds and much lower minimums. They start from 25K. So that in of its own tends to lower the barriers to entry versus a lot of the other more traditional options out there, like a private bank, where the minimums are typically much higher. So we offer a great entry point, and then also the funds that we've been offering has been very attractive for our members. So it's typically funds, tier one, private equity, venture capital opportunities that you might not even find in some of the regional private banks. So that's the feedback we've been getting. And so we've been attracting a lot of these high net worth clients. On the structured product side, because of the general sophistication of our members is also quite high. So they tend to come in actually knowing exactly what they want to, structure themselves. So we have tools like a custom fixed coupon note tool. You can select up to 4 underlyings, change the parameters, and get pricing within a couple of minutes. So that is another feature that has been doing tremendously well. So on the B2C side, traction has been really, really good. And then on the B2B partnerships business, that has been growing massively well. So we're heavily focused on expanding that right now. We're actually actively hiring, in fact, to more engineers, more product managers, because we're seeing such huge demand. So we've gone live with partners like Bank of Singapore and Hong Leong in Asia, but we're seeing quite a bit of traction with European banks. So that's an area that we're spending more time on.
So if I can be a little glib, you've got both the product, which you sell to your high net worth investors, and then you've got the platform, which you sell or partner to institutions. What's the balance in your business of those two, and is that changing?
So to be honest, the direct-to-consumer business remains the core of what we do. It's a flagship business for us, and it continues to be super important because it allows us to stay close to the client. And if you think of us as a platform business, our two direct-to-consumer businesses in the US and Singapore are actually our first clients, right? And so we've taken that and adapted that to other banks as well. In terms of revenue, we're actually seeing now majority of it coming actually from the B2B side of things. So from a resource standpoint, we're very heavily focused on B2B, at least in the immediate term. But as I mentioned, direct-to-consumer has been growing very organically and continues to do so. And it will continue to be very important for us.
You've got an intersection in your business of alternatives as products. I know you're heavy users of AI, and then the wealth tech, and you're based in Singapore with a sort of a global footprint. What is the aspects of your business that you think that traditional private banks will at some point have to adopt? And do you see them trying to do that, or will you always remain distinct or different from legacy private banking?
So I think, interestingly enough, private banks have now become more partners to us than competitors. And even if you look on the direct business side of things, oftentimes, if you look at our client base, we don't tend to overlap a lot with the partners that we work with. And the reason I'm saying that is because a lot of the clients that come to us, they typically want the self-serve model, right? They want to primarily be able to do everything themselves. And that's the type of client that we attract. But that's not going to take away from the clients that go to private banks or go to financial advisory firms, because fundamentally, those type of clients do want the hand holding and do want the kind of experience that you would get with a private bank. And so for us, we have not seen as much of that kind of overlap where, to be honest, we just serve very distinct type of client segments versus a private bank. In fact, the way that we've been working with private banks has been more, as I mentioned, in a partnership type way, where we have been powering a lot of their advisory capabilities using AI agents. So, we typically get into conversations where a bank would be thinking about, of course, AI is at the forefront of everyone's mind. It is on every executive agenda, and everyone wants to do something around AI. But the question typically for a bank is, do you build or buy, right? And that dilemma and that question typically kind of falls to one main question, right? Do you want to spend the next 2 years building, or do you want to move ahead with something much faster today and get going and focus on what you do best, which is you have the trust, you have the client networks, you have the distribution, you have the products. Let us handle the technology. So typically the partners that we work with, they agree with us, which is at the speed at which AI is moving, they would much rather have something right now and go to market as soon as possible.
But then there's going to be the very largest banks, I assume, will want to do this themselves. How big is your moat? I mean, LLMs make it quite easy to do a lot of things, and just throw a little bit of budget and they could probably create something akin to what you've got, because they'll just get their Claude or whatever to build. They'll just build it like this, and boom, they'll do it. So how do you maintain that edge?
So interestingly enough, we're actually right now working with some of the largest and oldest private banks in the world. Some of the names, everyone would be very familiar with. And for us, what we're seeing is that even if you look at the massive technology teams and budgets that these banks have, they just have way too many things to do as well, right? There are so many priorities, not just AI, but just kind of even to kind of keep things going from a technology perspective. The team is kind of very tied up with moving ahead with that. On the AI side of things, I think they do see the value of what we bring, which is that we are fundamentally an AI-driven company. So if you think about what we do every single day, we're just thinking about how do you deploy AI agents in wealth management. Even compared to some of the more generic LLM companies out there, everyone is looking into getting into the financial services space as well, right? And so you have Anthropic, you have kind of OpenAI, you have Google, all looking to kind of go into the financial services space, but they're also looking to go into many other industries as well, right? But the core, the kind of advantage that we have is twofold. One is we're primarily focused on wealth, and that's what we think about every single day. And the second thing is we also run our own regulated businesses in the US and in Singapore. And these banks recognize that we understand what it means to build AI agents with these kind of within a regulated environment, and we put very specific guardrails on the agents that we launch because we have that experience building our own regulated businesses.
Let's talk about the AI stuff then. I've got a few other areas of the business I'd like to get into, but you've mentioned it several times, and it's the fun stuff, right? It's the okay. So you guys have been around for sorry if I missed it, but about 2 years or so in the US and a year plus in Singapore, right?
It's about 3 years in the US, about 2 years in Singapore. Okay. Company itself has been around for about 5 years now.
Okay, all right. So I mean, roughly coinciding with when OpenAI put out ChatGPT 3.0 and we all went nuts. So what has been the way that you guys have approached AI, both of the sleeves of the business, and we'll just take them one at a time, but one faces a client, one is integrating into an institution's own operations. What is the, and how has that evolved? Because 3 years ago, the capabilities were less than they are now, obviously. So just curious about where did you begin and what's changed?
Yeah. So, I mean, to be honest, when we first incorporated a company back in 2021, we were already actively thinking about the use of AI within, investment strategies, within kind of the platform itself. It formed the core of what we do. But at that point in time, no one was talking about AI, right? And I guess that is one advantage of that is that it comes from our heritage. A whole bunch of founders kind of working on the LLM and AI teams within Google, and a large part of them being technologists themselves fundamentally. So we come with that heritage already. And of course, we just kind of accelerated that once, as you've mentioned, OpenAI came into the market 2 or 3 years ago. And since then, essentially, we've accelerated a lot of our efforts in terms of what we want, how we want to deploy these AI agents, right? In the past, it was kind of something that was a little bit more passive, but now it is kind of more in the forefront in terms of we think about it more actively throughout the entire user journey experience. So if you look at our direct-to-consumer app, when we went live in Singapore, we already had kind of AI agents that was powering the recap of your portfolio. And we have a research analyst AI agent that is able to help you generate kind of a research report, as well as a short list of stocks that meets an investment team. So that was something that we launched, already two years ago when OpenAI first came to the market. And since then, we've taken a lot of these capabilities and adapted that for how we can work with banks as well. So it is foundational kind of models that we then tweak and customize depending on what a bank's in-house investment framework and advisory framework might be. We've been very lucky, to be honest, to also be building in an environment like Singapore, where, as you know, MES and the government here has been tremendously supportive of the use of AI. So, for example, we're part of the MES's Path in AI program, which is their program to encourage the use of AI amongst financial institutions. So they are actually actively promoting us or kind of recommending us to a lot of these local banks, and they've been very, very helpful in that sense.
Does that stuff really move the needle, though, in terms of, I mean, it's efficient, and maybe clients like it for it's got that gee whiz aspect to it, but that's still not where an agent is perhaps providing actual advice or transacting for you. So that would be a step change, but I don't think anyone's doing that yet. But maybe you are, or you're thinking about it. What has to happen for that next change to come? And is that, just get a sense of to what extent you measure these AI capabilities in terms of differentiation magnitudes compared to people that don't use it?
Yeah. So that's a great question. We're actually in the midst of deploying an advisory agent, so actually providing advice based on a bank's in-house recommendation framework or portfolio optimizer. But there is a final kind of filter or check that happens, because ultimately it is an agent that is used by the advisor. So the advisory agent is meant to make an advisor more efficient. It is meant to help the advisor ensure that the recommendations they're making is in line with house views. And so it is not made directly available to end clients as yet. And to your question on what do we need to get done for that to be possible, I think it will take a little bit more time. There are specific additional guardrails that we need to put in place, especially when it comes to, letting an agent go kind of all out in making recommendations. There are very specific guardrails and controls you need to put in place. And I think we're maybe a little bit kind of further away from that for now. I think having the way we're deploying right now is to an advisor, but over time, I wouldn't be surprised if we start making it available to end clients, but with very specific controls.
What's for those sorts, whether it's the controls or just the comfort level, what are the biggest, let's say out of all of, there's many factors, but let's say, what would you think would be the one that is the most important that has to be resolved before any others can go ahead? So the tech itself, so controlling hallucinations and this sort of thing, which is very scary. Regulation, client attitude or client willingness to work with this, or just perhaps your own team's willingness to use this stuff. Where is going to be the hardest of those to move, but at the same time, I guess the most fundamental?
Yeah, so that's a fantastic question. I mean, if you look at from a client's perspective, there is already an expectation that they want advice to be driven, potentially by AI agents as well. And that's because on a day-to-day basis, they are already actively using, AI models like ChatGPT and Gemini. So there is already an expectation that, even for investment advice, that's something that, I should be getting. So we're getting these kind of questions, we're getting these kind of requests. But fundamentally, as to your point, from a regulatory standpoint, as well as a technology standpoint, we're just not there yet because, there is still that risk of hallucinations, which every firm is actively looking at what we do and looking at, how we kind of control that. And for us, we spend a lot of time doing AI evals, right? Every single model, every single kind of prompt, every single response that gets created, we spend a lot of time kind of going through all of that. So, I think over time that will improve, but the technology is something that we just need a little bit more time. And then on the regulatory side, just having very clear guidelines on what you can and cannot do and what you can and cannot recommend, and a way to evaluate the recommendations that I made. Right, I think that is still something that I think the regulators are actively working on, some faster than others. So you will see, I think we'll see certain markets, potentially like Singapore, moving a lot faster than some of the other jurisdictions.
Right. And then there's also the liability question.
Absolutely, yes, exactly.
Right. What about the intangibles around having your RMs use these for recommendations or providing information? By which I'm trying to say politely, what if they get really lazy? We're human, right? I mean, once we start getting these tools, we start outsourcing a little bit of our brain to them. And, so you have to sort of draw your own lines in terms of what you need to do, the grind that you've got to put in to stay on top of things versus what is a reasonable outsourcing of cognition, right? So how, as you've been using these agents and giving them more and more tasks, how do you make sure that the RMs don't just take it for granted, and that there will be a robust, the human in the loop is not just there to tick the box, but to actually really query what the agent is suggesting?
Yeah, no, so that's a very fair question. I think based on what we're seeing, fundamentally, most banks are seeing AI agents as a way to increase the efficiency of a banker, not to replace, advisors or bankers, right? If you think about a typical banker, they're typically servicing at least 100 to 150 clients or less, let's just say with a private bank. And based on that kind of client count, you can realistically only serve the top 20 or 10 to 20% very, very well, right? You just don't have time for all 100, 150 of them. But with the use of AI, you're able to kind of scale your efficiency and be able to provide advice and recommendations and engagement at scale. And that's the point of AI. It's not to replace the banker, but to make them a lot more efficient. And so the way that we have seen it being deployed right now is that it is almost like a sidekick or assistant to a banker. Fundamentally, the way in which a portfolio is being changed is still driven by the prompts of the advisor. So the advisor still goes in there and says, hey, I would like to reduce exposure to the US by 20%, or I would like to increase exposure to Chinese equities by 10%. So they're still making these prompts, and then a rationale is given. The AI agent helps with that. Okay, this recommendation, it may or may not deviate from CIO research. It may or may not deviate from in-house analyst research. It helps put these checks and balances in place for the advisor, right, to do so at scale. But the final decision is still on the advisor. So whatever recommendations made by the agent, whatever rationale is given, the advisor at the end of the day has to say, okay, this makes sense, let's proceed with it. So it's just to make their lives a lot more efficient, a lot easier, but the final decisions still sits with the advisor. Accountability of the recommendations that gets made to the client still sits with the advisor.
What are the limits to what you can do with a business that's structured like this? So on the one hand, because you've got, whether it's on the platform side, serving institutions around the world with your technology, or if it's with the client-facing side of the business, there's still some things. You're a technology company. You're not a bank. So you don't have, for some people, maybe the legacy does matter. That trust issue, family relationships can go back a long way. And you don't have the balance sheet. And so there's obviously you have a lot of products, but you don't necessarily have any kind of lending or that kind of sort of corporate finance advisory side that you can do because you don't have the banking relationship. So are those things that at some point you want to build into, or do you see the future of the business with all the costs and such that would entail, or do you see the business, at least for the next several years, just trying to scale as a tech company?
So we'll probably do both, right? The B2C, the partnerships business is important for us because it allows us to scale, but the direct to consumer, as I mentioned previously, it allows us to stay close to the client and improve the product, but also really control our fate in terms of how the business grows, right? You have a lot more control over direct to consumer business, versus a B2B enterprise business. So we like the idea of that. On whether we would expand beyond investment products, fundamentally, we recognize that wealth management is a lot broader than just investments, right? And so we have established partnerships with trust and estate planning companies, insurance companies. So we see that as kind of being our way forward, at least in the next couple of months in the short to medium term, where we would establish partnerships with folks that have deep experience in some of these domains, and we would just recommend our clients to them.
Let's talk a little bit about what's happening in the broader world of wealth and asset allocation. You have a lot around private assets, alternative assets. We've seen over the past year and a half, a lot of friction now with a lot of private credit funds that have been targeted at high net worth individuals, and a lot of perhaps misunderstandings about what that liquidity really means or about what the true risk appetite for clients is. And I think we're also seeing, as these funds sometimes with the gates, they tend to extend the life period than what was advertised on the fund's sort of label. A 3-year product can sometimes turn into quite a few years product, and then your annualized returns don't look so attractive on a 7 or 8 year basis as they do on a 3-year basis. So just what's happening, you're in that's a big part of your business. So what are those discussions like, and how are you trying to work with your clients or work with the manufacturers to figure out how to keep everybody happy?
Yep. So I think we have gotten questions from our clients, as with many other private banks and many other platforms. I think we are quite lucky that most, as I mentioned, most of our clients are in financial services themselves, and so sophistication level in terms of kind of them seeing the market cycles in the past and this happening is not entirely surprising for them. And so we haven't, I think, at least the feedback I've gotten is that we've not received as many questions as perhaps some of our peers, but we still do get them. And I think fundamentally, the way that we address it is twofold, right? First of all, it is, at the end of the day, education, ensuring that the people that are investing in these products understand the long-term nature of it, right? And the lockups that might be necessary. Naturally, with alternatives, it is not meant to be something that you would expect kind of immediate liquidity for. So you have to go in there being aware and being comfortable with the fact that your money would be locked up for 5, 7, 10 years or longer. So that's one, having the education and ensuring that the people that are investing in these funds are fully aware of the liquidity that they might get with their investment. The second thing is that we're quite different from some of the other platforms in the sense that we're not a marketplace, right? And this tends to be, some of the issues that we've seen in the market tends to be there is a wide dispersion in the quality of private market funds. Okay. And so, when you are a marketplace and you're coming in there and you're trying to buy something, you might at times get, funds that might not have great track records, or you might not know as well. The approach that we've taken since the very beginning is that we offer a very curated approach to how we, to private credit or private markets in general. Right. So we do the due diligence. We only make available the best of the best. And typically the funds that you see on our platform, we have 9 to 12 live at any point in time. So it's a very heavily curated approach that tends to be quite different from the marketplace platforms you see.
How do you make sure that when you design your AI agents that they align themselves with client interests and low fees or suitable advice versus let's face it, you're a distributor, and distributors often like to push what brings in commission.
So for us, well, first of all, I think we don't take trailer fees, so we don't get any kind of commissions from selling products. The only fee that we get from our clients is the very clear management fee that they see before they click on the invest button. So we're not incentivized to push any particular product, right?
Sure.
And the next part of that question is really we actually do have in-house advisors as well. So, if anyone has any questions, they can also speak to our advisors. We don't actually provide advice or recommendations via AI agents at this point in time. So if someone is looking for more information or they want advice, we direct them to one of our human advisors. So we do have a human in the loop as well. The AI agents is primarily there to provide an intelligence layer on top of the data.
Tokenization of real world assets / stablecoins is a really hot topic. But I often notice with people that are excited about it, there's sort of a discrepancy. So institutions like it because it has, it will free up a lot of capital. It's very efficient. They can crush costs, so they're very excited about that. But those things don't necessarily click with an investor or an issuer, right? That's not why they're in it. So what's your take on where will this go? I mean, I assume that you're looking at this and thinking about the kind of products that will or services that will be of interest. Just curious about where you see alignment between issuers, investors, and intermediaries.
Yeah. I think what's most interesting about tokenization is more in the transparency and the transactional aspect of it, right? The transparency into the transactional aspect of it that you might not otherwise get in the traditional fund structure. But I don't think the fundamental advantage of it is that you now get lower minimum ticket sizes, right? Because there are many other ways to potentially achieve that these days. And then more importantly, at least for us, our client base, by nature of being more private banking or accredited investors, they have not been, the ticket sizes that they're looking to invest in is not very small. So we haven't seen as much interest in tokenized assets as yet. But it's, as you mentioned, it's a topic that we are looking into, maybe for real world assets at some point in time, but not for now.
Yeah. So Amanda, thanks so much for your time. One last question for you. Arta's backers you've got the ex-Google alums. You've got a lot of very high-end VCs and Wall Street people, and then you've got Singapore government entities that are your shareholders. So where are the areas where, when you're thinking about new products or new markets or ways to drive the business forward, these are three very different kinds of backgrounds for your shareholders. Where is the conversation right now? Where are the areas where they have to figure out a common view?
Well, everyone is in agreement that, at least for our backers, I think everyone's in agreement that, fundamentally the company needs to be very focused on how do we drive growth via the AI side of things. So whether it is, using AI within the company, but more so also as a revenue driver in terms of the agents and the products that we offer to our clients, AI is a core part of it. It is in agreement with that. And I think we, as a company and our backers as well, also see huge growth with the enterprise side of things. And there is also a lot of interest, especially coming from the Economic Development Board here, for us to continue to scale and build the business out of Singapore as well. We have a whole bunch of engineers that are based here and building out of Singapore, and fundamentally that is something that they really like. I think in the current environment and the fact that Singapore is a huge international hub, everyone is in agreement that building out of here makes a lot of sense, and that's something that we're very focused on, scaling our business out of Singapore.
Okay, and beyond the private banks that are your clients, where you're helping them with their own technology, do you see a point where legacy private banks that aren't your clients are going to see you as a direct competitor?
Well, I'm sure some of them do. I think, for us, we see it both ways, right? I think we're as I mentioned earlier, we feel we kind of provide a very different type of offering to these clients, and we don't see typically an overlap. Those that would go to a traditional private bank would not typically come to Arta, and similarly, those that come directly to Arta would not, potentially go to a private bank and get, those advisory services anyway. So we don't see too much of an overlap there. We're very keen to work with these private banks to see if we can help them in any way using our technology. So we're coming at it more from a partnerships perspective. I think at the end of the day, as a business, we see ourselves very much as a startup, right? And for us to scale, we want to work with, some of the biggest institutions who have built trust and distribution networks over, hundreds of years. And so from our perspective, we're really coming in and seeing how we can scale what we built using partnerships.
Great. Amanda Ong from Arta Finance, thank you for joining me at the JDB Report.
Thank you so much for having me, Jake.